Welcome, trader friends. Well, we've just had a big week of Mag 7 earnings. Beats across the board. Meta, Amazon, Microsoft, all above consensus. The market is cheering. This presentation explains why that cheer may be the wrong reaction, and the options market should be pricing that currently isn't. As we know, the Iran war began 28th of February. Q1 closed 31st of March. That is 31 days of war impact baked into Q1 results. At the most, the Q2 reality hasn't landed yet. We're not bearish because the earnings were bad. We are bearish because the earnings were backward looking. And the forward picture is structurally broken in ways the consensus models have not built in. The core problem. 3 columns that represent 3 compounding failures in consensus analysis. Column 1, modelling the companies, not the war. Sell-side analysts are good at what they do. They model revenue, margins and capex within the system they know. The problem is that system has been structurally disrupted by this Middle East war. They are treating it as exogenous shock rather than a permanent regime change. Column 2, Q1 beats the pre-war data. This is the critical point. When you see Meta posts $10.44 adjusted EPS on 56.3 billion revenue, that revenue was earned in January, February, and up to 31 days of a war that was only just starting. The Q2 print will be the first full war quarter. Column 3, management guidance is compromised. Has anyone heard of a single CFO on an earnings call that says, "We are concerned about helium supply to TSMC"? No, they don't say that. They can't say that. It would crater their stock. So they stay cautiously optimistic things, and the consensus builds on a model on top of that. The market is reading Q1 results as confirmation that the Mag 7 can weather the war. We think it's reading the wrong data set. The supply chain nobody is modelling. Firstly, and I've talked about this before, helium. Qatar's Ras Laffan, the world's dominant helium source for TSMC, Samsung Korean fabs, and Japan's chip facilities are all run on Ras Laffan helium. The fabrication process uses helium as a cooling medium. It is not substitutable at short notice with anything else. 30 to 60 day buffer stock is the industry standard. After that, yields, the percentage of good chips per wafer, start falling. Throughput drops. NVIDIA cannot ship what TSMC cannot fabricate. NVIDIA's forward estimates are supported by high AI data demand, but demand doesn't matter if supply can't deliver. The other that no one else is talking about, except for the fryer, bromine. Okay, less well known than helium, but equally critical. Bromine compounds are used in printed circuit board flame retardants and chip packaging. The Dead Sea, Israel and Jordan, and Gulf Corridor supply the majority of global bromine. Both are disrupted. This is not a theoretical future risk. In fact, the clock started on the 28th of February. Neither of these appears in any Mag 7 earnings model that I've seen. That's the gap we're positioned to exploit. The East Asian fab chain. The Gulf supplies the chemicals. The East Asian fabs use those chemicals to build the chips. NVIDIA sells the chips. The data centers buy the chips. If the first link in that chain breaks, every number downstream is wrong. EWY and EWJ, which I've talked about. Okay, these are the structural bear candidates, not just short-term war plays. South Korea and Japan have double exposure. Energy cost surges because of the Gulf oil disrupted, and critical chemical inputs, helium, bromine and others, for their semiconductor industries are also disrupted by the war. This is why EWY, EWJ are different from, say, the European ETF. A German manufacturer faces high energy costs. A Korean chip fab faces higher energy costs and potentially cannot get the chemicals needed to run the fab at all. If TSMC's helium supply runs out in 60 days, where does NVIDIA's revenue growth come from? Answer me that. Q1 earnings. What the numbers actually tell us. Start with Meta. $10.44 adjusted EPS is a great number. It was earned before the recession signal fully activated and before ad budgets starting getting cut. Watch Q2 ad revenue guidance on the next call. Amazon. AWS beat massively, but Amazon's Bahrain data center was struck twice before Q1 closed. The write-downs and insurance costs from those strikes may not have fully hit the income statement yet. Microsoft has committed $15.2 billion to UAE AI and cloud infrastructure by 2029. No $1 of that is impaired on their books. Q2 guidance is the moment to watch. NVIDIA. The market loves NVIDIA's AI demand story. We don't dispute demand. Fryer disputes supply. You cannot sell chips you cannot make. Helium supply to TSMC is the number nobody is tracking. Tesla, blacklisted by the IRGC, Iranians, the only Mag 7 name with no obvious Gulf infrastructure rationale for being on that list. That's a targeted psychological operation. Add consumer confidence deterioration and Musk brand issues. This is potentially the weakest name in the cohort. The Q1 number is the rear view mirror. Q2 is the windscreen, and the windscreen has a war all over it.